we'll move into what we call the Platinum program. And what this is called is, we refer to this as a just missed opportunity. So what just missed means is, we talk about agency loans or Fannie Mae, Freddie Mac. Those are your agency or conforming conventional. There's a bunch of different names for them, but that's your vanilla cookie cutter, government backed everyday loan that 85, 90% of the people out there use to buy and refi and get into houses. Now you move into the jumbo world. Like today, our jumbo loan limit is 726, 400, 200, I believe. I'll double check that. So if you need to take a loan out for $800,000, you're going to fall outside of the max loan amount in our county. And most all of Florida is the same. You do have some high cost areas that are out there, like in the Northeast and Northwest and California and stuff like that. They get into higher loan limits. But for our purposes, 726, 200 is the top loan amount that we can offer. So what'll happen is those Fannie Freddie loans and even VA and FHA and USDA loans, those loans are packaged up into mortgage-backed securities, sold on the market, traded in Wall Street, and go and they perform in pools. They'll take, 2,000 loans or 10,000 loans and they'll put them together, and then investors back those loans, and those loans pay a profit to their shareholders of those securities. That's the way that works. Now, that's the reason why Fannie and Freddie loans are so easy to do, because we have guidelines about what fits and what doesn't. If they make the cut, they get in, we book them and we move on. Guidelines are very easy to comprehend, and you either fit or you don't. If you don't fit due to loan size, credit score, income, any of the stuff we've talked about, then you move into what we call portfolio loans. Portfolio loans are where individual institutions will put up their own money in the form of a portfolio product and don't pay attention to Fannie Freddie guidelines. All jumbo loans are portfolio loans. Now, your typical vanilla jumbo loans are going to be administered by the banks, Chase, Wells Fargo, Bank of America. They want to give good terms on jumbo loans because they know that that client is a good banking client. So they might give them a loss leader interest rate on a jumbo loan because they in turn get most of that client's credit cards. They get savings accounts, investment accounts, car loans, checking accounts. Maybe they have business accounts. They use that jumbo mortgage, which is highly securitized, highly collateralized, and very low risk, because they know that these people won't, the first payment to be made is going to be their house payment. So they can take a hit on the pricing for those loans to win that customer. Now, that is a portfolio loan. Now, for jumbo loans are much more strict. They want to see lower debt to income ratios. They want to see lower LTVs, higher down payments, better credit scores, all of that kind of stuff. They're very strict because they want to make sure that they have a good customer that they're getting on their books. Now, in this just missed program, what we say here is the borrower can qualify using our non-QM jumbo solutions, and it helps us close more loans. The reason for that is they are similar to a jumbo loan, but they might not quite have made it with Chase or Wells Fargo. So on these loans, we can go up to 90% loan to value. Pay attention to that risk model there. 10% down is much higher risk than these other ones that we're looking at with 30% down, like they're foreign national. So credit scores start at 680. Loans go up to 3 million, minimum 250. 4 years seasoning for all of the credit events. Foreclosure, short sale, bankruptcy, deed in lieu. Full doc only, so no DSCR, nothing like that. We need to see tax returns. We need to see income, pay statements, W-2s, whatever kind of income they have. So this will be a full W-2 run deal, and this will not be a bank statement program. This is different from our bank statement program. All occupancy types allowed: owner occupied, second homes, non-owner occupied, purchase or refi. Debt to income is going to be 40 over 50. That means 40 front end, which is your housing payment, and 50 maximum back end, which is all of your payments divided by your income. That's similar to a conventional debt to income restriction. Again, 40-year interest only is there, and you can actually qualify off of liquid assets. So what that means is, we touched on that earlier, assets as income. If you've got a client that has $5 million sitting around in a mutual fund or a 401k that they have access to, we can do some math and convert that into income and be able to show that this person has enough assets to pay for this loan, whether or not they have employment or self-employment or bank statements or anything like that. So if they have enough money sitting around and we were to turn that large $5 million account into an annuity where it starts paying them monthly or annually, then we're able to use those assets as income to qualify. So that's a big one that a lot of high net worth individuals can take advantage of. If their income is sporadic, or they don't want to document it, or they don't want us opening their tax returns for every single company that they own, that's a way to make that work. We get into full doc product Portfolio Select. This is a full doc product that offers the borrowers all the flexibility and features and benefits of the whole non-QM programs. So this is up to 85 LTV, 15% down. Credit scores start at 640. Only a 1-year seasoning for foreclosure, short sale, or deed in lieu. 2-year seasoning for bankruptcy. That means a Chapter 7 after it's discharged. Chapter 7 is the one where you wipe everything away. We need to be 2 years out from that, and we have to see no more delinquency after that 7 discharge. They have to have clean credit since that happened. And then a Chapter 13, which is the repayment plan. We need to see that 2 years from the filing of that 13 and that they made all their 13 payments on time. Can do purchase or refi. Loan amounts go up to $2 million. Owner-occupied second home investment, up to 50% debt to income, gift funds allowed. So a lot of times you might not get an approval for a 640 credit score with 20% down on a conventional loan for whatever reason. And then you'll see here this 1-year seasoning on a foreclosure is not going to fly in the conventional world. We need 7 years for that. We need 4 years for a short sale. We need more than that on a bankruptcy on a conventional loan. So this is another kind of a near miss product. If they can't get them qualified with conventional, then we kick them over here into Portfolio Select, and we see if we can get them a portfolio loan to make that work for them. So that is a good way to look at that.